Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to go over, there's a couple of graphs here. I was reading an article. I thought it was a pretty good article. So I wanted to share it with everybody because it's kind of an eye opener. It's kind of funny. I'm like laughing. So I've got the price here. And obviously they're charting two different things. And obviously if I were to ask you which one would you want to be invested in? You're going to say the green line. The green line is what I want to be invested in. It's obviously far better than the orange line. And what I'm going to tell you is the orange line and the green line are the same asset. This is gold and this is gold. This is gold priced in dollars. This is gold priced in Turkish lira from 2014 to 2018. Yeah. It's a trick question. I know. So it says, what about what the Turkey crisis teaches us about gold? And it says, if you were contemplating an investment at the beginning of 2014, which of the two assets graphed below would you prefer to own? Everyone chose the green line. It says, in the traditional and logical way of thinking about investing, the asset that appreciates more is usually the preferred choice. However, the chart above depicts the same asset expressed in two different currencies. The orange line is gold priced in US dollars, and the teal line is gold priced in Turkish lira. The y-axis is the price of gold divided by 100. And looking at this, the gold protected its wealth in relationship to both assets the same. So gold in dollars and gold in this, it had the same value in either currency. It's just the currency is fluctuating against gold. And I think that's what's difficult to grasp in a lot of these things. And now I'm looking at this chart here and I've got it behind me, and that's the same asset just priced in different currencies. And what do we have today? We have all of these currencies being debased. They're all being debased. And we're looking at these assets and we're pricing them in dollars. The dollar's been very strong in relationship to other currencies. And just looking at the chart behind me, that's exactly what's happening here. We're seeing all these currencies go down against the dollar. And I think at some point, I can't tell you when that point is, that these assets are going to get priced very differently against the dollar. But in the short term, we may see some wide fluctuations based off of other currencies being priced against the dollar and how these assets are priced against each other. It's a big currency game that's going on. But there's more in this article that I thought was pretty good. It says, this real-world example is elusive but important. It helps quantify the effects of the recent economic chaos in Turkey. Turkey's economic future remains uncertain, but the reality is that their currency has devalued as a result of large fiscal deficits and heavy borrowing used to make up the revenue shortfall. Inflation is not the cause of the problem. It is a symptom. The cause of the dramatic increase in the supply of lira designed to solve the poor fiscal condition. So what they're saying there is that the root cause is not inflation. It's the predicament that Turkey's in with their finances, their poor fiscal condition. The reason that they're printing all this money is because they don't have the revenues, and they've got this mismatch between revenues and spending. And they're printing the difference. Inflation is a symptom of that problem, of the predicament that they're in. Goes on to say, a Turkish citizen who held savings in lira is much worse off today than even 2 months ago, as the lira has fallen in value. She still has the same amount of savings, but the savings will buy far less today than only a few weeks ago. Her neighbor, who held gold instead of lira, has retained spending power and therefore wealth. This illustration highlights the ability of gold to convey clear comparisons of various countries' circumstances. It also illustrates the damage that imprudent monetary policy can inflict and the importance of gold as insurance against those policies. So coming down here, I really want to touch on this because everyone, they talk about inflation as rising prices. And it makes me want to I want to punch something. I don't know why. It's because I really want them to understand what inflation is. And this article does an incredibly good job of pointing out what inflation is. So I'm going to read this on what exactly inflation is. It says, most people think of inflation as rising prices. Although that is a way most economists represent inflation, the truth is that inflation is actually your money losing value. Inflation is not caused by rising prices. Rising prices are a symptom of inflation. The value of money declines as a result of increasing money supply provided by the stewards of monetary discipline, the Federal Reserve, or some other global central bank. Rising prices is not inflation. It is a symptom of inflation. Inflation is the increase in the money supply. Period. Everything else is symptoms. Money supply increases, we have inflation. All these people of what they're measuring are symptoms of inflation. There's some really other good things in this article. I really do like it. So here we go. It says, this is difficult to conceptualize. So let's bring it home in a simple example. If you live in a country where the annual inflation rate is steady by 2%, the value of the currency will decline every year by 2% on a compounded basis. At this rate, the purchasing power of the currency will be cut in half in less than 35 years. And obviously, in Turkey's case, they have a much higher inflation rate, which means that their currency's purchasing power is going to get cut very quickly. So coming in here, I'm going to go down a little bit. I'm going to go to the summary here. There are over 3,800 historical examples of paper currencies that no longer exist. Although some of these currencies, like the French franc or the Greek drachma, disappeared as a result of being replaced by an alternative, the euro. Many disappeared as a result of government imprudence, debauching the currency and hyperinflation. In all of these cases, persistent budget deficits and printed money were the common factors. This should sound worryingly familiar to our own situation in the United States. And they talk about this steady 2% inflation level, which is just debasing their currency. And it says the math is not complex, but it is difficult to grasp. Any number, no matter how small, compounded over a long enough time frame, eventually takes you on a parabolic hockey stick shape. The purpose of the inflation target is clearly intended to encourage borrowing, spending, and speculating as the value of the currency gradually erodes, but at an ever-accelerating pace. Ever-accelerating pace. Thus, those not participating in such acts will get left behind. In the same way that rising prices are a symptom of inflation attributable to too much money, printed money in the system, deflation is falling prices due to unfinanceable inventories and merchandise pushed onto the market caused by too much debt. Contrary to popular economic opinion, deflation is not falling prices caused by a technology-enhanced decline in the cost of production. That is more properly labeled as progress. The Fed is either knowingly or unknowingly conflating these two separate and very different issues under the deflation label as support for their inflation target. In doing so, they are creating the conditions for deflation as debt burdens mount. Gold, for all of its imperfections, offers a time-tested, stable base against which to measure the value of fiat currencies. Accountability cannot be denied. Despite the unwillingness of most central bankers to acknowledge gold's relevance, the currencies of nations will remain beholden to the barbarous relic, especially as governments continue to prove feckless in their application of fiscal and monetary discipline. So I just wanted to touch on that and show you that you've got two different charts. One's going through the roof, the other one's pretty much stable in relationship to each other, which is gold priced in two different currencies. These currencies worldwide are getting debased massively. So the way that I save is in precious metals, and that's why I have such a large savings of precious metals. And it's important to understand what inflation and deflation is. It is not measured by prices. Inflation is the expansion of credit or money. Deflation is the contraction of money or credit. And the way that we see that is you're going to have to destroy loans or increase loans in those two different scenarios. Increasing is inflationary, decreasing is deflationary. And you can't measure it by prices because that's a symptom. So hopefully this kind of opens your eyes on assets just being priced in different currencies, because that in itself is a ratio. So almost everything that you price is a ratio. It's just one thing priced against another. It could be that other thing could be a currency, that other thing could be something else, and you could see drastically different paradigms based off of the currency that you're looking at that asset with. So we could be going through a period where the dollar strengthens and other assets, or I should say other currencies, are getting destroyed. And assets will look very different in different currencies over those time frames. I do think our time in the sun for commodities will come. They're coming either way, and I think they're going to come in every single currency. And all currencies are being debased, and when you price them against each other, the ones that are the worst, which are most of these currencies overseas, they're going to get chopped off first, and then eventually the dollar is going to get hit. So I think we just need to be patient. I think we're in the right assets. We're just looking at things through the dollar lens. And the dollar lens may look very different than all the other currencies that they're looking at. And remember, supply and demand is going to be based off of wherever you live. A person who's in Turkey is obviously going to be buying gold, silver in mass. And what this is setting up is it's basically going to drain all of the gold and silver in all of these other countries with poor, we'll call it, with worse currencies. They're going to get their picks first because they're going to go bomb rushing into them. And then the US will be last because our dollar will be the strongest for the longest period of time. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.